and welcome back to another episode of RoQuanda's Real Estate Real Talk. On this episode, we are talking to Alex Otero, a local loan officer, for him to give us updated information on what's happening in today's market as it relates to the coronavirus and obtaining a loan today. We're going to discuss those things right after this, so you don't want to miss it. And we're meeting with Alex Otero, and now Alex is going to give us an update on the market as we stand today. So Alex, since March of 2020, we've been dealing with this pandemic. We've been dealing with the coronavirus and the recession that started basically in 2020, where people started to slow down. Businesses started to close, and then we heard that the Feds did two, drops from anywhere between 0 to 0.25%. So a lot of times I get inboxes and calls that say that they see that they can get a 0 interest rate for a mortgage. Can you give us some insight on that, please?
Well, if that was the case, you got to sign me up too. But no, no, 0% mortgages. And I've been on a lot of conference calls when it came down to that, advising realtors and clients. So the 0% really had a lot more effect on the credit card industries, 0% APR, 0% credit cards overall that the Fed wanted to drop to have more people have options to, of course, spend, right? So less rates, more people want to spend. When I say we, I mean the mortgage industry doesn't go off the Fed. It's a indicator, but it's not the specified indicator that the mortgage industry uses. We use what's called MBS, mortgage-backed securities. Mortgage-backed securities is what we follow to be able to determine where the interest rates are going. So granted, the rates have fallen down, and they've been at historic lows either way for some time, but it wasn't such a huge hit the way a lot of people anticipated it, because it still comes back to risk. Risk meaning that banks still have to evaluate a person's credit score, a person's income, a person's down payment, meaning if the person's going to finance 95% compared to somebody financing 85% or 80%, the risk factor is going to be different. So the rate typically is going to be higher on that capacity. So even during this pandemic going on, we're seeing rates anywhere between 3.2 to about 4.375. So I always like giving a variance because everybody qualifies for a different amount. But realistically, it's still a very low rate, RoQuanda. I mean, we're still in historic lows. When you look at the 40-year average, you're looking anywhere between 7.5% interest rate. People back in the day were taking mortgages at 8%, 9%, 7%. So we're historically at a low capacity right now. A lot of people don't know or wouldn't remember or wouldn't have any idea. That's why I always like to express it. But somebody getting a 3.5, even a 4.2, it's still a great rate to be able to go down. But just to clarify, there is no 0% rates on mortgages because the bank has to make money and the bank has to get out the money from the government as well. So there's a lot of inclination in between the two that has to be combined. And that's why it'll never be a 0%.
Awesome. Now, right now, you basically answered my second question. The interest rates right now, again, it varies based on the person's income, how much you're putting down, their credit score. But again, can you just recap what is the range? And I know that changes every day, but what is the range a person's looking for as far as a loan when it comes down to FHA?
Okay, great question. So actually, that was a big change that took place about a couple of weeks ago. Where FHA, at least we, PRMG, had our minimum credit score at 580. So I was closing loans 580, 582, person would close. Of course, during this pandemic, a lot of guidelines changed because the risk factors changed. So now the minimal FHA score we would accept is a 620 credit score or higher. Conventional, you still definitely want to be in the 680, 690, 700 range. But speaking about FHA, 620 or higher. Now, the question is going to definitely come back that, Alex, I got a 622, would I still qualify? I'm going to say yes and no. Yes and no, because yes, you meet the minimal standards, possibly not only because the cost of that rate is now very high. The reason is because FHA is not supporting certain credit scores. I mean, FHA knows that who knows where we're going to be 3 months from now. So what they're doing is they're ensuring that they're not going to pretty much have somebody at 620, 630 credit score get a loan. So if they're not going to support or be what you call insuring that loan, the lender has to figure out a way what to do with those loans. So the only way that the lender can kind of offset their numbers is by charging a fee, or charging a discount point, if you will, for a set rate. So right now, kind of over the last week, I've been seeing 3.6, 3.75 for a 630 credit score, but actually costs about $10,000. 8 to 10,000. I mean, that's a lot, right? And the reason for that is because they have to offset the risk factor and the cost for that. Now, a lot of people understand that's more of a deterrent, because a lot of people are not going to come in with down payment, closing costs, and an additional $8 to $10,000 for their rate. So the goal that I try to do now, of course, is try to get that credit score from a 630 to a 660 to a 680. And there's a system that we have called a wayfinder, which basically does a rapid rescore. It tells me exactly what that client needs to do to take them from a 630 to a 660 or 670. And I advise the client they might have to invest some money into paying down some credit cards or paying some credit cards off, but it gets their credit score higher, and then they're going to save in the long run when it comes down to that. I just did a client on Friday. She was in those situations always like this, right? So she was a 584. I had already qualified, but with all the changes, we had to get them up. So I was able to get him up in the end to 653 credit score. So now he has definitely a fighting chance to be able to move forward. He did what he was supposed to, and at the end of the day, both him and his wife, of course, they were able to make it happen. So now they have a loan. So it just really comes down to looking at every single client on its own merit, because everybody is different. When you got that neighbor that said, "Oh, RoQuanda, I got that 3.15. Oh, RoQuanda, I got a 2 points," take it with a grain of salt, because at the end of the day, everybody is different. So that's what we as mortgage loan originators have to analyze and look at and give an updated analysis on how we can be able to assist them, whether it's now or whether it's in the future, but at least a guidance on what they can do. Right before this call, I was on a client call right now, advising somebody how to get their credit score a little higher because the credit score didn't come up. And that's great. So he goes into my file, my follow-up file, which I'll always be following up within a couple weeks to see if they're doing the right steps. And like I said, those to me are one of my favorite clients, because we took them from not being able to qualify at all to now owning their home. And that's to me
Those are
one
my
of the
favorite
best
clients as well. I love that, just to see their
Absolutely.
face,
Yes, absolutely.
So I have another question for you, Alex. Okay, so right now, because the interest rates are low and we are going through this situation right now, do you recommend people to move forward with purchasing a home?
Yes, absolutely. Great question, because this is a time right now where, I mean, I'm going to say it mainly for those who have the right mind and understanding that this is going to pass. So now's the time to really jump into the market and take advantage of it, because there are people that are very scared, very nervous, not knowing what's going to happen. So they're kind of taking a step back out of the market. So they're kind of not really looking. Well, that's actually going to favor those who know, you know what, this passed. Thank goodness I'm still working. I'm still able to move forward. So let me continue looking out for a property. And what they're going to find is there's not a lot of competition. That one property that normally has 4 or 5 offers is now only going to have 1 or 2, if that. And by that person being that 1 or 2, you're going to have a fighting chance of getting that property. Same thing with the sellers. Not a lot of people buying, so the sellers are going to have an opportunity to sell their property to that 1 or 2 people that's out there looking. And they're really going to make sure that they're improving going forward. Obviously, the sellers will want to have more people obviously go into their property, but at the same time, they'll have more streamlined, qualified people trying to buy their property. So it is a great time to sell, and it's a great time to buy, because there's not a lot of competition out there right now.
All right. And my last question before I let you go, of course, there's a lot of different loans, but most commonly people are getting the FHA loan and the conventional loan. Do they have a choice, or is it basically what the system says is best for them?
Well, the system, to make that decision, typically it's going to be myself, someone in my position, because what I look at is the income and the credit, and of course the down payment. So first and foremost, yes, you're absolutely right. FHA and conventional are the 2 main ones that people take. Obviously, if they're a VA, a veteran would go on a VA loan and go that route. But FHA and conventional are the 2 main ones. Now, FHA and conventional actually both have a first-time home buyer down payment program that they could use, or availability, which is a minimal down payment with FHA is 3.5%. Conventional is 3%. Now, with conventional though, Your mortgage insurance only lasts until you have 20% of equity into the property. Then it falls off.
Okay.
With FHA, it's for the life of the loan. So even if you put 20% down in FHA, you're still going to have mortgage insurance. Now, why do I say that? Because the biggest difference between conventional and FHA is the debt to income ratio, the amount of money they allow you to borrow. For example, conventional allows you to borrow 50% of your income. So I'll give you an example. If the person makes $5,000 gross, the max they can use is $2,500, 50%. Now, under that 50%, the $2,500, what has to go under that is going to be their new housing payment, principal and interest, taxes, insurance, mortgage insurance, HOA, if there's an HOA, and everything reporting on their credit, whether it's a car payment, credit cards, what have you. All of that has to be under $2,500. Why? Because the other $2,500 is going to be used for gas, clothes, food, groceries, entertainment, everything like that. That's the model of the debt to income ratio. The first 50% is for your debts and everything reporting on your credit, and the second 50% is for everything else, right? Now, with FHA, they allow you to go up to 56.9% of your income. So that's $2,845. So instead of using only up to $2,500, they go up to $2,845. So that gives that person $345 more of buying power to be able to increase. The reason why I mentioned that is because I've done credit scores at 730 and they have an FHA. Why? They have a great credit score. They could typically go conventional, but their income wasn't there to that type of house they want to buy. So when I put them at FHA, now they qualify for that house because that extra quote unquote $300, for example, got them that ability to now purchase that home that they couldn't before. So that for me is one of the biggest things, and that's why it's so important to have a knowledgeable mortgage loan officer to kind of analyze the situation, because I could be able to see where I could go and how I could help the client achieve their goal. You know, there's a lot of houses in the market. You definitely want to have the option. That's why when I get my clients pre-approved, I pre-approve from the highest amount that they possibly can, and they can work their numbers down. So at that stage, I always confirm what's going to be the best route with them, but that's where I analyze if it's going to be best doing an FHA or conventional.
All right, perfect. I am so thankful for you answering and saying, yes, I'll jump on the Zoom with you, RoQuanda. You are so appreciated. And I know people ask these questions all the time. So I'm going to pause right now, and I'm going to look and see if there's any questions that I'm getting on Facebook or any questions they may have that you can answer. So if there's any questions, you guys, let's see. I have a couple of people viewing. If you guys are out there and have any questions for Alex,
I'm here.
Before we hang up, go ahead and just type them in. Let's give them a few seconds to do that. So while we do that, so far I have no additional questions. Okay, I get this a lot about closing costs.
Okay.
Okay, closing costs. So when you say closing costs, what does that mean?
Okay, so, and that's actually a great point because a lot of people have this misconception. So closing costs think about it as a big umbrella. What has to fit under that? So closing costs, you're going to have your lender's closing costs. You're going to have the title fees. You're going to have the third-party fees. Third-party fees, by the way, is like the transfer tax, state and county fees that they charge for purchasing a home in your county or in your state. And then the last part is escrow. Now, escrow is actually the client's money. That's just being a prepaid amount, paying for their taxes and insurance up front. So they're going to bring, because when they're purchasing a home, they have to bring those funds up front to set up their escrow account. And escrow accounts to make sure that they have enough money in that account to always pay for their taxes and insurance every single year. So those four areas is what's under the total closing costs. So I've seen clients that, you know, they'll get my, as we call closing disclosure or loan estimate, and they see closing costs and it's just this huge number. And like, Alex, you know, this is not what we talked. I said, no, that's why I'm going to discuss it. We break it down, and sure enough, I show them this portion is your money just prepaying, but this is the actual cost. And when they come to find out, the cost obviously is a lot lower than a lot of times what I've always discussed, because I always overestimate my fees, so they come in a lot less. I always want my clients to make sure they bring in less, not more, of course. But that's the biggest thing with closing costs. Those are four areas that you have to break down: lender, title, third-party fees, and escrow.
Awesome. All right. So I think that there's no more questions that's coming through on Facebook. So go ahead, Alex, again, and give your name. I'm going to make you large so they can see you. Give your name, the company, and your phone number.
Absolutely. Alex Otero with PRMG Mortgage. You can reach me at 305-733-4629, or you can reach my website to research myself and my team at aotero.myprmg.net.
Awesome. Well, Alex, thank you so much for your time. I know that you're absolutely busy. Thank you for being a great loan officer. Thank you for answering my phone calls when I call.
Of course.
Thank you for getting my clients to the closing table.
Always, that's right. Thank you for the opportunity.
I hope this interview was awesome and amazing for you. If you thought it was amazing, go ahead and hit the like button, go ahead and hit the subscribe button, and don't forget about the bell so that you can receive notifications each and every time I do videos on a weekly basis so that you do not miss the content. Until the next video, you guys, be blessed, and don't forget to watch the videos that's up here, over there, or even down here. I promise you, they're all packed with a lot of information to keep you informed. Until the next video, you guys, be blessed.